We're now going to have a look at our final set of ratios that's going to help us interpret the performance and position of an entity when looking at their financial statements. In this session, we're going to have a look at 2 more ratios, and then in the following sessions, we'll bring these ratios to life by applying them to some numbers. Now, in this session, we're going to have a look at long-term solvency, long-term health of a business. And really, the best way we can look at and analyse the long-term health of the business is by using the gearing ratio. Gearing is all about how risky a business is perceived to be. Now, when we think about risky, what we're thinking about here is in terms of long-term borrowing. Do you remember with long-term borrowing, like loan notes, there is an obligation to pay that money back in the future. But not only the capital or principal amount, but with interest. Higher borrowing, higher interest. Really, it's that risk, that interest risk, that is the focus of gearing. Now, we have to contrast that long-term borrowing and that risk of paying the interest against the other way a business is financed in the long term, and that's through equity, which, if you remember, we said that equity, there is no obligation to pay that money back. Remember, shares last as long as the business does. So with equity, there's no risk, really. Remember, we don't have to pay dividends, and we don't have to pay that money back. It's the same with what we saw in a few chapters earlier when we looked at limited companies. So equity is deemed as a low-risk way of generating finance, whereas long-term borrowing is a more risky way of generating income because you have to pay that money back in the future and you also have to pay interest on that amount. So what we do is we take our long-term debt, our non-current liabilities, our loan notes or loans, and divide that by our capital employed. Do you remember we said that was equity plus long-term debt? We used it when we looked at return on capital employed and asset turnover a few sessions previously. Now, if you multiply that by 100, that's going to give you a percentage. A percentage of your long-term debt over your total long-term finance, debt and equity. Now, of course, if the numerator is getting bigger, well, then your gearing will get bigger and bigger and bigger as well as time goes on. So as a general assumption, high gearing is bad, and the lower that percentage is good. Okay, as a general assumption. If your gearing percentage is increasing from last year, it's because you've issued more loan notes, let's say, and therefore you've increased your obligations and increased your risk. Okay, if it gets lower, maybe you've redeemed some of your debt, and as such, that risk of paying the interest and paying back the obligation goes down as a result. So gearing is all about risk, okay? How risky a business is perceived to be in the context of meeting its obligations. Is it going to pay back those long-term debts and also the interest as well? Now, again, that will only mean something if you compare it year on year or to an industry average. But to be honest, every business is different. Most businesses have to find a balance of debt and equity that suits them. As long as they can pay the interest each year, and they also have enough profits to cover their interest or their finance cost, and we have enough cash to pay that and pay the ultimate obligation in a few years' time, then really that's not a problem, okay? So you really need to think about gearing in terms of cash, but also profitability as well. Do we have enough profits to cover our finance cost? Now, gearing can also be expressed as debt over equity. So rather than taking debt over debt plus equity, you can take it over debt over equity instead, and still times it by 100, and it will give you a percentage. So gearing could be either or those two different ways of expressing it. But either way, it's going to tell you largely the similar sort of thing. Okay. Our final ratio then is interest cover. Now, if you remember interest cover, do you remember how I said, do we have enough profits to cover our finance cost? Well, that's interest cover. And this really does link into the gearing ratio that we've just seen. Do we have enough profit for interest and tax? Do you remember we called that operating profit? Do we have enough profits before interest and tax to cover our interest payable, our interest expense, or our finance costs that we've shown on our statement of comprehensive income? You're going to take your operating profit, divide it by your finance cost in the period, and that's going to give you the number of times your profits cover your interest expense. Now, a minimum of 1 is obviously going to be expected, but anything greater than 2 times is considered healthy. So if your profit before interest and tax is 2 times the amount of interest, well, then you have enough profits to cover your interest expense. Now, of course, that's great. Profits are great. But again, you might want to think about, do we have enough cash to cover our interest as well? Because remember, profits do not equal cash because of the way the accounts are prepared on the accruals basis. So yes, interest cover is great, and you do need to learn this ratio, but you must also consider cash. Do we have enough cash to pay for our interest? That would also be another bit of analysis that you could do. Okay? Yep, we've got enough profits, but do we have enough cash to pay our interest obligation each year? And that's it. That's our final 2 ratios done, gearing and interest cover. Thinking about the long-term solvency of a business. In our final 2 sessions, we're going to have a go at doing some ratios and really looking at all the ratios that we've covered and putting that into an exam context by doing some of those ratio calculations in a question.